Let's talk about what really is happening within the universe of commodity, considering supply snarls clearly is what one is witnessing across the commodity universe. In the meantime, aluminum has managed to hit $3,000 as well, just overnight, and crude continues to rally amid supply fears as well. In the meantime, mining and metal production cost pressures as well continue to bog down. So let's discuss all of that and more with Peter McGuire. He joins in the show right now. Peter, first, let's talk about aluminum. The fact that it's already at $3,000 right now. What's been leading to this kind of uptick that you're seeing? Because, even back home, we are seeing most of these aluminum stocks just hold out at record highs.
Yeah, exactly. And good afternoon, or good morning, I should say. Yeah, it's been an absolute bull market over the last month and a bit. Absolutely, pushed up considerably. I think it's up around about 18 or 19% in that period. So, yeah, it's been just dramatic. And will it go higher? Yeah, I think it's got to possibly, I'm thinking maybe a 31, 3,200 handle as far as, when it gets a little bit exhausted. But it's had such a big move that I think it's taken traders by surprise. It's certainly taken the market by surprise, and it's just not unusual when you see commodities that they're on that bull market ride. It just seems to gather momentum day on day over that month period. So yeah, been very, very strong.
Yeah, that they sure are. What about copper though? Because there have been frequent strikes that one has seen at key mines at the world's largest producer, that's Chile. How does that impact the demand supply scenario?
Well, if I look at price first off, as far as copper, it's seen nothing like what we've seen as to its little brother aluminium. Copper's been flatlining. It really hasn't had a lot of move, and it corrected itself with that big spank down from 11,000 to that 9,000, 9,200. I think it's running at about 9,500 at the moment, and there just doesn't seem to be a lot of momentum to push it higher in the short run. So that's the situation that we're seeing, very much range bound, and all of the speculation money hasn't been looking for a home on copper. It was very much farmed over to the aluminium market. And when I look at also, moving forward, possibly over the next 3 to 4 months leading up to Christmas, I'm not looking at anything dramatic to push it higher above 10,000. So we've just got to wait and see what happens from a global demand picture. And the great concern to everyone at the moment is shipping costs and what impact that's having to commodities themselves.
Yeah, we'll talk about that massive surge in shipping costs that we have seen. But, let's keep it with aluminum, because that's really the metal that's, like you mentioned, surprising everyone. We have the perfect concoction. So the troubles in Guinea, plus then you had, strikes in a Canadian smelter, and then China itself is also cutting down aluminum production. So right now, if we have to take everything into consideration, do you think that the market could be in a deficit?
Well, I think it probably is in a little bit of a deficit. That's probably contributing to that big push up that we've seen as far as price spike. There's the first part, but then needs to be considered as far as those big freight costs that you've got to, regardless of what we say, it's got to be shipped, it's got to be moved, it's got to go from on a supply line from somewhere to somewhere else, and with the cost of shipping and the way it is. I was just looking at the Baltic Dry Freight Index, and that gives me a consideration as far as aluminium prices. This time last year, you're running about $1,250 to $1,500 on the Baltic Dry. Now you're running at about $4,000. So that gives the consumer out there and the trader a real perspective as far as that's got to be built in. And the built in has got to be paid for by the consumer. So that really is the consideration at the moment. Whilst you've got those supply issues and you've got bottlenecks and different disruption mechanisms that can impact the market, then you've got the next part. Of course, it's got to be moved, and you've got to go somewhere as far as to a smelter, or to be produced, or turned into something, and then it's got to be shipped. So yeah, I think that the storyline on aluminium has been a very, very interesting one from a trading perspective over the short run.
Okay, let's talk about then those shipping costs. Peter, in the first place, I mean, this is the genesis of, I guess, inflation that we'll be seeing across the world as well, right? If your basic cost of transportation itself, which is all pervasive, is going to be so high, obviously it's something that's going to lead to a massive surge in prices all around the world. So to start with, what do you think is the reason for the shipping costs skyrocketing the way they are?
Well, I think that, I've been watching these markets for about 30 odd years, and I just think to myself, or maybe longer, and I just think to myself, it is longer than 30 years. I look at the price and I think to myself, we go through such big, broad ranges across the commodity sector. And when you're tying that into a shipping component, you've got supply and demand. And we all understand to take a ship and to charter that ship, what the actual raw cost is, remembering that a lot of these ships are now paying considerably more than what they were paying this time last year because of fuel costs. So the diesel goes into running these ships and so on are just significantly higher today than what they were a year ago. And the man and the woman on the street are paying for that with their hard currency. And that truly is the consideration that needs to be, I think, brought into context from an inflation standpoint. So all things seem to be going up. I haven't been to your wonderful country for about nearly 2 years now, but I'll tell you what, I haven't moved out of Sydney, but things are certainly far more expensive here with all forms of base metals for housing or for construction, certainly for foods, certainly for the consumption as far as crude oil. So all of those components, and a lot of them have to be shipped in, are all being felt to the consumer.
Peter, the more I look at ESG, the more I'm getting convinced that while ESG is important, but is ESG costing, or is ESG implementation coming at a cost of inflation? Because with ESG, you will have to be very conscious about how are you producing, where are you producing, and how much are you producing, which is leading to this entire commodity inflation. And inflation is a bad word. Nobody wants inflation.
Well, you don't want inflation. It'd be all right if you're getting 10% on your money in the bank and inflation's 12%. You'd live with that. But when you're getting zero in the bank as far as a deposit, and your inflation's running on 10 or 15%, then that impact, the consumer is being hit everywhere from their purse and their wallet. And that is the consideration that many people are feeling. I've seen the price of stud lumber in the States. Absolutely. Some of these prices were up 30%. Meat prices, and beef prices, pork, chicken, all of these, so that from a protein component. Then you're looking at base metals. Then you look at energy prices across the commodity complex. We've been and then think about precious metals. So all of those ingredients that go into price discovery, and that's what the price is at the end of the day, traded, that is the dynamic nature of these markets. And in a lot of ways, we had a very good run for a couple of years because we had low energy prices and we had relatively contained inflation. But when you pump trillions and trillions of dollars into the global economy due to the COVID environment, the outcome has got to be, to some point, you're going to get some inflation. And that's what we're feeling at the moment.
So do you think it's a matter of time? Banks will be coming out and saying, look, we'll start lending back to coal producers, commodity producers. China will start adding capacity and more demand, more supply would come up, and that's going to be end of the commodity uptick. Because right now, yes, demand is there, but supply has been cut down unnaturally because of unnatural factors like banks and ESG.
Yes, of course, and that's a consideration. So they've got to take on board from a risk perspective. Do they want to lend to those particular corporations? And then the next part is, like anything, and everything is cyclical. And we can go back and we can put our minds back. And I always tell that story as far as nickel. And nickel's a great commodity to actually examine, where it went from $52,000 a metric ton going back all those years ago, and it collapsed to about $7,000 or $8,000 a metric ton. And that just demonstrates the huge price spikes and price collapses that you see in the commodity sector. And maybe we're heading ourselves up for a time where these prices aren't going to be sustainable, or they're going to drive further up from here. But I do believe one thing. I think we're going to see a great amount of volatility across some of those markets in the short to medium term when you comprise US dollar sensitivity and, of course, the inflation storyline.
Okay. Well, Peter, it was great chatting with you. Thanks so much, as always, for sharing with us your take on what's happening. There's just so many moving parts, so many events. That's usually the case with commodities, but the kind of ramifications it has, right from currency to interest rates, is something I think you've shared with us very well. Thanks so much once again for joining in. And with that, we're going to take a short break on the show. Be right back.
Thank you very much.